name is Deandra Coleman, and I'm with the Virginia SBDC Network. For those of you that are not familiar with our organization, the Virginia Small Business Development Center is a partnership program between the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 27 locations across the Commonwealth, we provide training and technical assistance to small businesses and their local communities. Our one-on-one consulting services are available at no charge. Today's webinar, Reviewing Your Financials and Budget, is presented by the Alexandria and Mason Small Business Development Centers. Be sure to check out our next webinar, Attracting, Retaining, and Reskilling Talent, on September 30th. We are recording today's presentation. You will all receive a copy of the recording and the slides, and it will be posted on our website. Due to the large number of participants, everyone's microphone is muted, but if you have questions during the presentation, you can type those into the Q&A box. We have also enabled the live transcript function, which you can adjust these settings via your controls at the bottom of your Zoom window. And now it is my pleasure to introduce our presenter for today's session. Tim is the director of the Mason Small Business Development Center and provides business counseling and mentoring for Virginia entrepreneurs and small business owners. Since 2009, Tim has counseled over 1,200 clients, providing advice on launching, financing, marketing, and selling their business. Tim is a practice entrepreneur with over 30 years of finance and operations experience for technology and services growth companies in the commercial and government sectors. He is founding director of Mason Venture Mentors, a provider of business advisory services to startup technology companies. Through Venture Mentors, he has provided leadership roles in several companies, including Nexus Technology Services, Visionary Consulting Partners, and Next Breath, a division of the Aptar Group Incorporated. Please join me, everyone, in welcoming Tim Johnson.
Thank you, everyone. Good morning. Glad everybody's here. Thank you to our sponsors. Thank you to the Alexandria SBDC, Bill and Gloria. We really appreciate teaming up here. So I am Tim Johnson, the director of the Mason Small Business Development Center, and between the two centers, we really do cover Northern Virginia. And so one of the things I'd like to go ahead and do is just tell you a little bit more about the SBDC services. As Deandra mentioned, we have 27 centers throughout the Commonwealth, and we are pretty much gold and expected to be a leader driving economic impact. So what do we do? Well, it is all about one-on-one business counseling and advisory services. So if you haven't sought us out, our centers are open and it is free of charge. We also do lots of small group training seminars and these larger workshops to kind of give you the information that you need to help you grow your business. And of course, we are a great resource to local, state, federal, and private sources to help you get your business moving in the right direction. So what are we measured on? Well, it really comes down to the economic impact areas. I am doing my best to close my own picture here. So what we're gold on? Well, job growth. So jobs created, jobs retained, something we measure. And the way we do that is every time we'll have a session with you, we'll ask, did you hire anybody? We're also going to measure sales growth and your capital investment into the business. We certainly measure some of the financial impact from the COVID relief that we were able to get over the last 18 months. And we also measure new business starts. So if we have some entrepreneurs on here, we're here to assist getting those businesses launched. So for today's workshop, I'm going to really talk a little bit about financials, getting a little bit into the numbers, but I'm not going to bore you with a lot of spreadsheets and in theory. What I thought I'd do is really talk about some of the practical experiences I've had as a counselor and the interactions that I've had with some of our clients. We're going to get into budgets and projections, and we're going to talk a little bit about key performance indicators. But the first thing I'm going to do is we're going to launch a couple of polls here. First, I'd just like to know a little bit about you, and so I'd like to know, what industry are you in? So go ahead and you tell me what your business is focused on, and you just sort of like to get a sense of what that looks like. The second poll we're going to do is I just kind of like to know how big you are. So we've got a short poll here to just to say, do you have any employees and how many? So as you're filling out these polls, I'm just going to move on and just a little bit about me. As my bio sort of indicated, we've got a lot of experience. I'm often in the financial and the operational roles of companies. And one of my very first jobs at a college took me to a large international shipping company, and they were responsible for shipping very large cargoes. Specifically, their largest client was Caterpillar Tractor, to destinations throughout the world. And when I was hired, it was they were based out of the port of New Orleans, but Caterpillar said, yeah, we'd like you to open up branch offices up and down the East and West Coast. So my first job was to open those offices. So from an accounting and finance perspective, I had to learn all about all the local requirements to opening a business. I had to set up a variety of KPIs and budgets for each one of those offices, and I had to manage cash. We were often dealing in millions of dollars worth of cargo every single week. So it was, you would say, how I learned the ropes. After I left that, after a few years, and moved back to the Washington area, I joined an architecture firm. I had studied architecture and business in college, but I didn't want to go into practice architecture. I was really dealing with the business side. So as part of my initial experiences there, the architecture firm focused half on commercial and half on government. So now I got a great sort of foundational learning experience on how to be a government contractor from a financial perspective. That also then led me into a series of technology companies that went from startups to mature companies, and one of my most recent gigs with a company called NextBreath was acquired by a public company, and I for a number of years had to be the one to manage the financial reporting as required what a public company would do. So my experience has taught me a great deal, and I bring that experience to every single one-on-one counseling session. When I get into the things that I'd like to talk about in this, I'd like to talk a little bit about what we learned during the pandemic, and we want to talk a little bit about accounting, because some of the accounting that we do, we're not always on the same page. And then when I start a counseling session, where do I start the review, and what kind of issues do I typically find? So what did we learn during the pandemic? Well, one thing we found is we needed tax returns. If you applied for EIDL, they were looking to review and verify that you indeed were in business. They were asking you to allow them to get your tax return transcripts of 2019. And then even as we moved forward into 2020, tax returns became an important component to understand what you were eligible for. So when we think about things that related to EIDL, they were focused on trying to get you 6 months worth of operating capital in order for you to continue the business. Unfortunately, they held it at 150,000. Have allowed to increase that to 500,000, but at this point, we haven't seen a lot of companies that have gotten that full 500,000 yet. We also needed quarterly financials. As we went to PPP2, they were looking to show that you actually had a decline in gross receipts of 25% or more in order for you to qualify for PPP2. We needed to calculate payroll at different times in different periods, and then we needed to manage our cash carefully. I couldn't tell you how many times that people got into the pandemic. They thought this was going to be a short-term, I would say, shutdown, and it certainly lasted a lot longer. And a lot of companies waited a little too long to start really conserving cash and managing that. And of course, many of our SBDC counselors across the state really were there to see if we can't get you through the pandemic without significant risk of potentially shutting down. And of course, we needed to utilize all the assistance programs that were out there. I was often surprised that they would tap the federal, but didn't realize that we had state and local programs that were also available. And we also found that the business community didn't realize that many of the banks are still open for business doing traditional loans, and we had the ability to get additional financial resources to get us through this. So when we get into the accounting side, I'm probably going to do my last poll here. I'd like to know what kind of accounting system do you use? We're talking about QuickBooks or a couple of the others, or do you just manage things kind of related to spreadsheets? What I find is oftentimes, many of our business owners, we're often relying on sort of last minute accounting or third parties to get their accounting caught up. And as we needed financials to support some of the pandemic assistance, yeah, we weren't really ready to deal with that. So when I mean we weren't on the same page, I'd often ask the question, well, who does your books? Are you doing it internally? You've got a bookkeeper, an office manager. Are you using an outside CPA firm or bookkeeping firm? And then what is that process? Are you doing cash or accounting accrual accounting? And oftentimes people didn't always know what the difference is. Typically we do cash for tax returns, but accrual is where we're actually measuring our accounting activities in the month that they occur. I have a slide a little bit later that's in your slide deck. I'm not going to bring it up here. It's a little too detailed. But really what we find is a cash where it's only accounting for when it really hits the bank account. We now may find that you may have a transaction where you got paid 90 days later from when you incurred the expense. And when we're looking at monthly profitability and monthly financials, we often find that we think we had a great month or a bad month because of the sort of a mismatch of timing. Accrual takes care of that, and I see that many of you are out there doing QuickBooks. QuickBooks allows you to toggle between cash and accrual, and accrual really is what you would say the larger organizations are always striving for. And some organizations like government contracting, as you get into becoming a larger government contractor, they're going to expect you to be doing your books on accrual based. Doesn't mean you have to do your tax return on accrual based, but it's a great way to keep track of it. And then when we think about tax returns as your basis for what you might be submitting to a bank, as opposed to regular audited financials, we often find significant differences. And one of the things that's hard for a business owner to understand is how do you, the difference between a tax return and a traditional financial statement. We're also finding that you don't always keep your accounting systems up to date. You may be 2, 3, 4 months behind, and a financial institution is looking for something to understand where you are today. And of course, we often find that you're really measuring your business health strictly based on the cash that's in the bank, and we're not anticipating what might be coming down the road. So when I get into it, where do I start the review? Well, I kind of want to know, well, how do you invoice your clients and how do you pay your bills? Are you doing it through your accounting system, or is it when you get around to it? When do you reconcile your bank accounts or your credit card statements? Are you doing that at the end of each month, or is it, again, we lag and do it periodically or even at all? Do you track accounts receivable? So at any point, you know what your clients owe you. And the same goes with accounts payables. At any given time, do you know who you owe money to in an organized, formal approach? And of course, we also like to know, how is payroll entered into your accounting system? We often use third-party payroll systems. They might, QuickBooks through Intuit. You certainly can do payroll through them, but we're often using a third-party service like Paychex or Paycom that allow us to use some other benefit services that they have. But how do we get those transactions into the system? So once I'm kind of get through and understand it, and oftentimes we're doing reviews where they can bring up their QuickBooks system, and I'll ask them to do a report. Let's compare 2 years, January to December 2019 to the same period in 2018. And it allows me to kind of go through each account and understand a little bit about how things have changed. In this example, we saw income actually declining from 2019 to 2018, but they actually were able to reduce expense even further. So they actually increased their gross profit. And so what I want to do is sort of understand what goes into some of these accounts. And what's great about QuickBooks is if we have a question, we can just double click on a number right within the report, and it'll take you down to the transactional level so we can actually see what's going on. This is often where my starting point is, but then I'd like to take it to the next level, which is actually taking a profit and loss report and looking at it monthly. It's changing the column to a monthly format. And now I can actually see the transaction at the account levels that are going through. And now I can also look at each of the months. And if we see a spike in a particular month, what caused that spike? And then we can tunnel down and look at those transactions. And we often find this is where we get, I didn't know that occurred in that month because the business owner was not necessarily looking at a report at this level. They look at the high level, and oftentimes that high level doesn't get down to the understanding of what happens. When I was doing work dealing with the public company and doing our monthly reporting, I was required very much to be able to come in and explain variances in transactions as an ongoing report, and this is exactly the approach that I took. And then, of course, we do want to take a look at the balance sheet. Right now, I'm just showing you the asset side, but we want to look at the liability side. And in every one of these accounts, can I say, well, can we prove these balances? So checking account, for example, we want to know, have you reconciled it? So we know what outstanding checks or outstanding deposits that haven't cleared the bank at the end of the month. We want to know from an accounts receivable standpoint, do we have an accounts receivable aging a report that matches this number? Same goes on the payables side. Do we have an accurate accounts payable number, an accurate credit card number? And then, of course, if you've got an outstanding loan, can we prove this is the current loan balance? So we often get into those discussions about how we reconcile that. So some of the common issues that I find through these review processes, well, first of all, incorrect account entries. And one of the things that's good about QuickBooks is if you have a vendor and you post a bill into the vendor bill section, it'll ask you what account do you want to apply this vendor to. And then one of the things it's good about is it remembers the last time you did this, and it'll bring up that account as its default. And so if you actually put the wrong account, for example, you put a telephone bill in the in the travel section, as an example, could become completely unrelated. QuickBooks will bring that same account up next time. So when we do those initial monthly reviews and we find these sort of wide swings or just big balances in certain accounts, it's often that we're applying the transactions to the wrong account. Account structure. One of the things that QuickBooks does come is it's got a standard chart of accounts coming right out of it, but it is kind of optimized for tax. It's pretty flat. It doesn't have a lot of categories. And if the idea is we want to have an idea of what are different cost areas like sales and marketing, as opposed to general and administrative, opposed to cost of goods sold, or even other operational areas, we have the ability to create accounts and sub-accounts in sort of a logical account structure. Often find that we see it's good for tax, but not necessarily at the cost center level. And so I often are advising to have a better account structure that allows you a better understanding of how you're spending your money. Payroll entries. We're often finding that we're entering our payroll incorrectly into our accounting system. For example, if you do a payroll service like Paychecks, they will reach into your bank account and pull out the net pay. These are the amounts of total of the checks that are going to the employees, and then they'll pull out a separate transaction that are all the tax payments that include the employee tax withholdings to the federal and state level. Well, and you're posting the net pay to payroll, and you're posting the combination of all the tax payments to payroll tax. That's actually not correct. We're actually should be doing gross payroll, and only the payroll portion that's responsible for the employer. That's the payroll tax for Social Security and Medicare. So we're understating our payroll or our salaries, and we're overstating our payroll taxes. This actually caused some problems with some of our clients because they were basing their payroll from their financial statements for some of the PPP calculations incorrectly and they were actually entitled to a bigger PPP as a result. So we often have to correct that and understand that. And we're only recording the sale when the check is deposited. This is sort of the cash versus accrual. We have the ability to write an invoice in the month that it occurs. QuickBooks will tell you, oh yeah, this is the month it applies to. But if you're waiting to post that transaction and that invoice at the point that check is deposited, again, we're not really getting good information of the performance of your business. And often we're using third-party billing systems to support our invoicing, pretty common in the healthcare arena, but it's not linked to QuickBooks. So QuickBooks doesn't know what you're billing your clients. We don't get that benefit of that information within QuickBooks. But oftentimes there is a process where we could go through and actually import some of this information, and that's some of the things that we like to work with. So once we get through that review process, we'd like to set some accounting goals. Can we get to the point that you can close your books within 5 business days? So I had to do 3 business days with a public company, and that means getting all your invoicing to your clients done, getting your invoices posted from your vendor bill, as your vendor bills, getting your credit card and bank statements reconciled, and then any accrual journal entries where you don't have a physical invoice or bill, we can accrue for them and get them done within 5 business days. And then you as a business owner should do an internal review, just like I do, and do it every month, and then look for those anomalies and get that opportunity to correct it then. And then also at that same point, do some cash planning and have this rolling 3-month view, so we know that that we can anticipate any big surprises or potential concerns that you might have a cash shortfall to make a payroll, or you need to get on one of your clients. You would say get on their back to get them to pay your bills. So we like to do those planning processes at the same time. And at this point, this is a good time to say, well, it's an excellent time to start thinking about creating a budget or a forecast or projection, and then actually start to compare our monthly actuals against that budget. So now I'm going to kind of go into sort of the budget and forecasting and projection side of this part. And so this might be a good time to say, Deandra, is there any questions at the Q&A screen so far?
I don't see any questions as of yet.
I guess I'm explaining it also perfectly. That's great. So when we think about what is a financial model, really it's an appropriate simulation that does need to have some good operational algorithms that are built into it. We have some great templates that we use. One of our sister organizations, Score, out there has a great library of templates, but we often have to modify them to meet your specific business need. And so, so as a result, ultimately, we'd like you to be able to think about having a model that really does speak to how your transactional flow actually occurs. So when we think about why we might want to go and do this, well, one of the things that we can get out of a future forecast, we can look at some of the industry benchmarks or ratios that we can help get. We have subscriptions to software services like Profit Sense, and they can give us some really good ratios of what your industry is actually doing. And those are very helpful to know. Well, are you operating kind of within what the operational goals are? So when we get into this and we build these, we want to make sure that we are using it And when we're comparing against actuals, it helps us identify problems before they arise. And you and your management team can work towards addressing those problems before they become an issue. We can look at trends and how things are growing, both from a sales or cost side. We can make staffing decisions as a result. If we hit a certain growth margin, now it's time to really say we can afford adding new staff to support our business. And then we also may be doing these budgets or models to support contract pricing, or we're looking at product profitability. Are we making a sufficient profit on it? Wrap rate is a government contracting term to understand what is your indirect rate makeup look like. So when you're doing pricing for bill rates, a wrap rate is that amount that you apply to somebody's direct salary rate. And it's the multiplier to say this is what we should be billing to create that fully loaded bill rate. If you're getting into looking at doing a loan, you will certainly be asked to do a 2-year forecast going forward. They want to know, are you driving cash profitability? It's going to help you allow you to pay it. And we certainly are looking at aligning your financial resources, things like lines of credit and potential access to other types of loans aligned with your plans. And of course, what the banks want to know is it demonstrates your ability to repay these loans. So a good financial model really consists of 2 things: well thought out projections about the future of the business. So if we are adding products or services, we want to think through that process in a properly structured, understandable, and dynamic spreadsheet that we would like to say, if you do the what ifs, can we do it? And we want input from your team. It's not just you and your accountant or bookkeeper. It really should involve everybody's thought into it. We'd like you to build a model that predicts cash and profit by month for the next 2 years. We like to be able to do a comparison of future projections against prior years, gives you an indication in there. And we like you to do it in the same format that your P&L is already done. So when we do these P&L reviews, let's make sure we're doing our forecast in exactly the same thing. So it may include all the same cost categories that we can roll up and look at the highest level, or we can roll down and look at the line item level. So one of the most biggest challenges is, well, what kind of methods might we use to predict sales? Because that's often the highest part. And when we think about the elements that go into sales, that could be sales and marketing, prospecting, having a sales manager meet certain quotas. It may be things that are driving customers to come to you. We want to make sure those sales drivers are in your control, and that sort of makes sense. So we need to think critically about it. So things that we do want to bring in, that if you have contracts that are there, we'll want to forecast those out before we bring in the pipeline of new work that ultimately might come in. Or we might be thinking about renewals or seasonal trends. Obviously, things like retailers, it's really often about driving customers to your store. If it's food service, often the same thing. But if it's professional services and government contracting, yeah, we're often dealing with finding the next customer, and so we want to take into consideration, often these components. And I often say, don't forget the capacity to deliver as an important component. You may want to have a strong 50% growth year over year, but your ability to deliver 50% more revenue may be a challenge because of the ability to hire and bring these people in to get the work done. And we often can get ourselves really so down into the weeds that we get into this scenario that I call over modeling, and then it becomes a challenge to be able to step back and look at it. Is this realistic? Where it becomes a challenge to say, well, our growth is too strong, or our growth is not aggressive enough, but we've done too much to the model that it makes it hard to be able to make changes on the fly. So we also do need to bring this model in where our labor costs should be from a bottoms-up staffing plan. So we want to identify each FTE and when they come into the plan. We want to be able to assign the staff at the cost center level, and then we want to bring in the other costs that are associated with hiring headcount. That's fringe expenses, that might be communication. We may want to be paying bonuses, commissions, and raises that are associated with that. So we want our models to include that. And of course, some of our non-labor expenses in the overhead, sales and marketing, G&A expenses, we can use normal spending as part of our trend. We can bring in the annual one-time expenses, things like liability, insurance. We know we tend to pay that once a year, or personal property or business property expenses. Let's get them slotted in the correct month. And then, of course, if we're thinking about gross spending, we're going to look at recruiting. We're going to look at potential facility growth and any new hire one-time costs that you need to bring into the business. And then we want to go ahead and do monthly reviews to see our actuals versus our projected. And we're going to monitor cost overruns or underruns. So are we spending hot in a particular area? Do we know why? And if we're underspending, is that potentially impacting our growth plan? If you anticipated bringing on a couple of sales reps and you haven't, well, that might look good from an underspending, but might impact your ability to close new deals. We also, some banks have something called coverage ratios against their loans. We want to make sure that we're making sure that we're staying within lines of some of those coverage ratios. And then we certainly have the opportunity to evaluate, do we need additional capital? We often say the time to increase a line of credit is not when you need that increase, but in anticipation of that increase. And then we can modify our plans quarterly and make those adjustments to reset our expectations on how our year is going to go. And that we want to continue to ensure this strategy is being executed, hence, drive it down to your management team to make sure that they are part of this conversation. And of course, this is really important that as your business grows, it can be a very important component of price proposals. For example, if you're adding FTEs and your overhead rate starts to decline, that can help you price more competitively with some of your business proposals. Kind of the things that I certainly have spent a great deal of time thinking about. So when we actually now get into looking at some of the best practices in terms of managing things like cash, we're always reminding, try and collect your receivables in a timely manner. One of the things I used to do is after 2 weeks, I always wanted to make sure if the accounts payable department received the invoice that I sent them. I didn't wait till it got past due, because oftentimes that accounts payable department has to send it to your end user that has to approve your invoice. I'd rather make sure that process is happening internally on our customer side. We can often offer discounts for early payments if that makes sense from a profitability standpoint. And when we're paying our bills, we can do automatic electronic payments and wait till the very last day possible to make a payment. That keeps more of your cash in your bank account when you're paying your vendors. Make sure your invoices are correct when they go out the first time. If it comes back with an error, that starts the clock all over again. And of course, we're always thinking about reducing things like inventory errors or shipping errors, because that again potentially delays when ultimately you're going to get paid. And don't overorder your inventory or your products. Having a big supply of something that may take you a year to overcome is challenging to your bank account. Yeah, you might be able to take advantage of some volume discounts, but is that worthwhile if you're struggling to manage your cash account? And of course, you can also go out to bid for goods and services, get your vendors to be competitive, and you're getting the best price. So when we think about the monthly things that you might want to do, is one thing we might want to do is consider creating a scorecard. That's something that you can look at visually and know what's on track and what's off track. We can look for anomalies, both good and bad, and they are leading indicators to understand if we're ultimately getting into trouble from the standpoint of how the business is filling. And of course, every business may have a different scorecard, and it certainly is what we would work with you to determine what numbers make sense and how many. And you may want to create something called a visual dashboard. If you're using QuickBooks, there's often a lot of third-party software that's out there, and even QuickBooks itself allow you to, as a business owner, assuming the transactional flow is current and up to date, you now can to quickly at a glance see some of the trends and some of the most important key performance indicators that certainly might make sense. And so we often are working with some of the vendors out there to optimize these kinds of things. And if we have a representative from Intuit, we appreciate some of the third-party services as well as some of the own software that you put in to help this happen. So with that, I'm going to kind of get into some of the key performance indicators that we think are important. But this is, again, another good stopping point to say, Deandra, are there any questions?
Yeah, we have a couple of questions here. So for a first-time profit loss projection simulation, what would be my first step? Should I keep startup costs and operating costs separate?
Oh, absolutely. So as we're thinking about what does it take to get in business, and then once business is up and running, we think operationally, we're going to want to see the operational costs in line with the sales or revenue that are going to come in, and know what month we're going to be cash profitable, and so that's going to be a pretty good indicator, because if we have those months where we're ramping up and we're running operating losses plus the startup expenses, now gives you an idea just how much capital you need to reserve to make sure you can get to that profitable state. So when we think about your startup expenses, we want to be as detailed as possible. Oftentimes, you may need to go out and get some additional financing to do that. I would say that that startup expense list should be, as if you had the money today and you're ready to go starting to buy stuff. Operationally, the biggest challenge is really on the sales algorithms that are going to drive what sales are going to come in. It's pretty easy to kind of figure out the cost side. We're going to spend a lot of time thinking through who your customer is and how we approach that customer, and understanding what often the sales cycle might ultimately be.
And as a follow-up to that, my business would need building material, supplies, and new operating space. Should the rent for the new space be included in the first profit loss projection?
Absolutely. So we can, if you're not sure where you're going to go, we have sort of benchmarks of what price per square foot would be, and if you know approximately what square footage you're going to ultimately need. When we're buying materials, if it's specific to delivering your say the service or contract that you're doing, the materials should be kind of in line with your sales projection. If it is specific to building inventory, if you were, let's say, retail, and then ultimately need that sort of baseline inventory amount, yes, that would kind of come in from the beginning. But then we have to think about what is the reorder algorithm that ultimately go into your projections.
What are some things that should be included in a scorecard or a dashboard?
Good question. I'm going to get into that in the very next set of slides.
Perfect. And we'll have one more here. We have someone asking, is there a software, accounting software that you would recommend as a craft distillery to use specific software for the distillery side of the business for sales, TTB reporting, paying federal tax, etc. But currently they are using Excel for basic accounting, but it is becoming very cumbersome.
So probably the two leading software packages out there that certainly can accommodate, not specific to breweries, but you essentially are a manufacturer. QuickBooks for manufacturing or Oracle's NetSuite, both are highly configurable, do have all the bells and whistles, have the ability to manage your supply ordering, have the ability to manage your the output that you're doing. If you're ultimately selling not just a tasting room, but ultimately distributing. Yeah, those software platforms absolutely can meet the bill, and they're both affordable.
I think that we have a couple, but maybe we'll move on now and then we can come back to these at the end.
Okay. Well, I think we're making pretty good time, so don't hesitate to put some answers in here. Put some questions in here. I'll think about the answers. Anyway, I'm going to kind of end this part in really talking about key performance indicators, and these are the dashboard items or other indicators that you and your team certainly should consider and potentially focus on. And it really comes in 4 parts of what is the elements of a key performance indicator. First is a measure. What is that unit of measure you're trying to capture? Do you have a target? What are you trying to achieve in terms of a measurement and knowing if you're on target or potentially lagging? We have to have a reliable data source, and so we shouldn't have a bunch of different data sources. We want to focus on one that is accurate and meaningful. And we need to know the reporting frequency. When do you capture this information? So kind of to give you a context of that, there are kind of 3 different types of KPIs that make sense in how you approach it. And the first one I'm going to demonstrate is just pure raw numbers. So for example, the measure would be the number of new customers. Our target is we want to get to 1,000. Our source would be our CRM system. And we want to measure this on a monthly basis. Another type of KPI might be progress, where we want to know what % complete are we against achieving a particular goal. Our target is getting to 100%. Our goal may be, our source may be coming from our project plan or our information about costs or other elements to show what % complete we're at. And we may only want to do this on a quarterly basis. Or a third component might be change. How are we measuring change over time? An example from a measurement standpoint is our % increase in sales. Our target might be, we're trying to grow at 22%. Our source is our profit and loss statement. And again, we want to focus on this on a monthly basis. So kind of think about KPIs that are meaningful to you. Are they raw numbers? Are they progress-based? Are they change-based? So to kind of give you a whole series of examples, I've got a number in here. I've got a total of 30, but they're actually, when we're looking to do a full 2-hour webinar on creating dashboards and KPIs, we're actually finding hundreds, if not 1,000 KPIs that we could consider and trying to figure out which ones might make the best sense. So some of the KPIs that might be sales driven. One of the ones I like is number 3, the number of qualified leads in the sales funnel. And when we think about what is a qualified lead, well, it is, do they have a need about what you're selling? And, is it somebody that you've identified that is in part of the decision process that ultimately can make a decision as to, wanting to be the person that ultimately signs the contract or is making that buying decision. So we kind of think of these sort of what makes sense from driving ultimately sales. You can also look at these and say, are these raw numbers? Are these progress, or these that we're measuring change over time? Another one might be your financial KPIs, and these are your traditional things that come from your profit and loss statement. One of the things that I find often is really important for businesses like retail or manufacturing Inventory turnover, how fast is that inventory, from the point that you acquire it to the point that you need to reorder. The faster the inventory, often the better performance. If you're going outside or your inventory is lasting, or you have on your shelves too long, or you're finding that you often have obsolete inventory, gives you the opportunity to make adjustments. Another KPI that might be focused on is the customer side, and certainly one I like is number 16, customer reviews. We are often really getting you to focus on getting your customers to say good things about you. We would expect that almost every business should have a Google My Business profile, and that allows you to put your customer reviews right there. Could be Yelp, it could be testimonials on your website, but getting understanding how many customers you can get every single month might be important. Another set of KPIs could be the operational side, and these are things that your team is striving to ultimately getting more efficiencies on the floor. One I like, and because I have spent a lot of time in the professional services and services industry in general, is number 22, the average employee utilization rate. So if you have a bunch of employees that are, ideally are billable because you make your revenue based on the number of billable hours they have in the month, what is their average utilization rate? We build models that predict that and say, in order for me to make a profit, I need my average utilization rate to be at 75%. So we want to report on that every single month, and that data source might be coming from your timesheet system. But when we think of these are often KPIs that are part of your planning process, and then so we have a goal in mind, and then we can measure the outcome. And then the last are some of the marketing KPIs. We think about things like website traffic as we work with clients in optimizing their SEO and driving campaigns that are going to drive traffic to your website. We want to be able to monitor that, so we're going to turn some of those reporting tools that we can get from Google or some of the social media sites to be able to measure traffic. Things like number of qualified leads that are going to be coming on. That is often driven based on good marketing outputs. Number 27 is one that I really like, is the conversion rate to call to action content. If you have a website up there, one of the things that we want people to do is say, we have a solution for you. Click here. Here's the content that is enticing you to click. Are they clicking on it, and what's the frequency? From an SEO standpoint, what are the top search engine results that are important to your business? And then we are always trying to get new content out there, and so we know we need to focus on purposing blog articles in order to continue getting our potential clients reading about us. And that could even be into things like ebooks for our technology companies. So all of these are often just a sample of what could be out there. What we like to do from a counseling standpoint is focus on what ones that might make sense for your business type. So what are KPIs next steps? We don't want all of them, but let's choose 5 or 7 that might be having the most meaning to your business, and assign an owner, not a business owner from the standpoint of who owns the business, but if they're doing a sales KPI, it might be your VP of sales, or somebody from an operational role that has a responsibility for actually having the biggest influence on achieving that performance indicator. KPIs can certainly be set at a department level or at a company level. They don't have to be globally. They can you can set your sales and marketing team to have KPIs that they're responsible for, and your operational team would be focused on something different. And we certainly want to look at your industry's KPIs. We have some great tools out there to be able to go out and look at how the bigger companies are managing their KPIs that they may be using to report to analysts on ultimately how they're doing. Certainly, some of the traditional financial ones are going to be there. Let's see if we can find some other ones. We have a subscription to IBIS World. It is a tremendous resource when we look at the various industry standard and informational reports about almost any industry sector we can find. And then one of the things that we often find is also valuable while we may be doing some of our initial budgeting and forecasting. Strategic planning is another process that every company ultimately should consider in periods of time, during their growth evolution. So we think of a planning process that might be a 5-year plan. We certainly want to bring in some of the KPIs to support that planning process. So again, we as a counseling component, we often focus on best practices around strategic planning. What have we learned about your performance indicators up till now, or might be coming out of your more tactical planning? And we always say, share this with your team. So it's not just, shouldn't be done in a silo. Not only should your team help provide input and own it, use it to educate your entire organization on how you're doing. Now we know some things are confidential, other things the team wants to know how we're doing. So with that, I have come to the end of this, and Gloria, yeah, I got it all done in the number of slides where you said, yeah, was I going to talk fast? I certainly did. So with that, I'm going to turn it back to Deandra, and let's get some questions in here because we've got some time to talk about this.
All right, thanks, Tim. We got some questions. There is one I want to go back to a couple of sections ago. You're talking about actively using a budget, and you had mentioned check coverage ratios on financial products. We had someone ask what exactly a coverage ratio was.
Coverage ratio, so there's something called a debt coverage ratio that a bank may say that when it compares, an example, your current assets that are on your balance sheet against your current debt. Industry expectations are that for every dollar of debt, you should have $1.2 of assets to support it. So debt coverage says, that the business is remaining healthy, and then ultimately can, if they liquidate assets, can repay debts. So that certainly would be a debt coverage ratio that we see that are often traditional with lines of credits and some types of term loans, especially draw term loans where you're going setting up a loan where you're going to use it for the construction process through a period, and then ultimately turns into a longer term loan. So that tends to be where your financial institutions are going to dictate what some of those ratios might be.
The cost of goods has been so high and has become difficult to make a profit. What will be the appropriate % rate to add to clients?
So that's a good question, and obviously we always have to think of what the market will bear in terms of increases to your materials costs or your cost of goods sold. We certainly support a number in the construction industry, and we saw this big disruption in the supply chain, and we certainly saw that once the supply chain recovered, things that we had bid on 3 months ago now were significantly higher. One of the things we like to do is can we work that into the contract so that the customer is aware that prices could increase if ultimately you have no choice in order to maintain the same profit margin you're ultimately striving towards. As we're building a budget for, let's say, 2022, certainly not a bad idea to incorporate an anticipated price increase from the material side that translates into your sales goal, that we still can maintain that same type of profit margin. We do hope that prices will come down as our supply chains you would say, kind of are reestablished and mature. And it doesn't mean that you can't lower your prices if the supply chain prices have come down, because we do need to consider our competition and being price competitive. When we think about the other best practices is let's try and make sure that we can diversify some of our supply chain and to look for other vendors. So we can get them materials that you need sooner, or potentially can find another source with a better price.
What would be a good source to access industry KPIs?
So two that we subscribe to is IBIS World and Profit Sense. Both of them have the ability to look at a collection of companies in every single industry, and that will help drive some of the KPIs that they report on. But you also can do some Google searches. Public companies often publish some of their KPIs, where we can deduce some of their KPIs, or look at some of the strategic planning organizations. Some of the KPIs that I put out there was a company called On Strategy. They are, they're one of the leading providers of this kind of approach. They certainly would probably publish typical meaningful KPIs for a bunch of different industries, kind of based on their enticing you to potentially engage with them to help you figure this out.
My business is making clothes and selling them online. What are a few KPIs that you would recommend focusing on?
So first on the certainly on the marketing side, we're looking at KPIs dealing with traffic and the effectiveness of your marketing programs. So it certainly could be number of engagements and the growth of those engagements over time. From an operational standpoint, certainly would be looking at your sort of inventory turnover and time to market. How fast can you get your clothes made and out to market? So we can set some goals and then ultimately see if we can exceed those goals in getting your product to your customers. Returns and reviews would be a good one to focus on, and then probably a couple of the just pure financial ones. Are we achieving some of our profitability goals and our overall sales goals?
We've got time for one more in here. What would you consider an industry standard regarding a % increase in your budget?
Oh, that's a good question. I probably want to look at that specific industry in order to sort of make a judgment. Certain industries, and I didn't. Was it on the cost side or on the sales side? Would you say that question is geared towards?
I'm not sure.
So if we look at the sales side,
they say sales side.
Sales side. So that's good. So industry by industry, when we are at certain, you would say, stages in terms of maturity with your business, if you're early stage, your sales growth can be almost exponentially a lot quicker than if you're in a later stage and significantly more mature. We always have to overlay the ability from a capacity standpoint to meet some of those growth functions. And when we look at businesses that are in technology, have the opportunity to grow faster. Businesses in, say, food service or retail tend to grow much more modestly because it is trying to bring those customers into the store. Once you get to a certain plateau, it's often hard to predict growth over that. From from professional services, often is very capacity driven. So every time, if I had an accounting firm, every time I brought in a new bookkeeper or CPA, that might drive that step function. Every FTE brings another 150,000 in terms of sales opportunities. So we are always going to be driven on that. And then ultimately, if it is sales cycle driven, that from the point of making contact with a potential client to the point that you close a sale and are driving that sale, and that's a 3-month period, we often want to say, well, if we're driving more into the sales funnel, but we know it's not going to close for 3 months, that may be a driver. So we look at those industries that are focused on that, and what kind of growth do they experience. Some of those larger companies that we can find some of that information. So that's a pretty broad set. I think ultimately we'd like to know your industry, your business type, and see ultimately how.
Yeah, absolutely. And I think that if you want to follow up with that and sign up for a session.
We are now at the.
Oh,
we are,
sorry. I think you cut out there for a second and just came back.
Yeah, sorry about that. Hopefully you got the end of that. With Zoom, you're often challenged with that. So all we can say is, come for counseling. We will drive to those sales growth algorithms, and that ultimately will hope to establish something that we would hope is reasonable.
All right. Well, I think that we actually got through all of the questions, which was great. There were a few of you that I asked to send over an email so you can sign up for some counseling. Again, it's free and confidential, so be sure to take advantage of that. This was with Mason and Alexandria today, which covers Northern Virginia, but we have centers all across the state. So no matter where you are in Virginia, we can assist you. So be sure to send us an email, help@virginiasbdc.org. You all will receive an email with a link to the recording and evaluation and to the slides today. And if you'd like to sign up for upcoming webinars or access recorded webinars, you can visit us at virginiasbdc.org/training. And be sure to check out the next webinar with Alexandra, Attracting, Retaining, and Reskilling Talent, which is going to be September 30th. Also on our website, you can access the COVID Business Recovery Center, which we developed to help owners not only continue business operations, but to thrive and recover. And these resources are, of course, designed to be used in collaboration with your local SBDC advisors. I also quickly wanted to mention that we are still working through this week with a team of researchers to better understand the needs of entrepreneurs and small business owners in the state. As part of this project, they have asked us to talk with our clients and others who have attended our workshops. All data will be held completely confidential, and you can sign up at the Calendly link I provided for you in the chat, and we will also send that out in our follow-up email. And I think that about covers it. Thank you, Tim, for spending so much time with us and for making such an educational and engaging session. We really appreciate your time. Thank you so much.
And well, thank you for attending, and look forward to hopefully seeing some of you in person.
All right, sounds good. Thank you all. We hope to see y'all at the next session. Bye-bye.